Hello everyone, and welcome back to Daily Dollars. Today, we're taking a deep dive into a new proposal coming out of the United States Senate that could offer meaningful financial relief for older Americans. We're talking about a new $6,000 federal tax deduction, part of a broader piece of legislation currently being debated in Congress, officially titled the One Big Beautiful Bill Act. This deduction, being referred to as a senior bonus, is aimed specifically at Americans aged 65 and older, and it could help you save big when tax season rolls around. If you're a senior, a retiree living on a fixed income, or simply someone trying to keep up with the latest decisions coming out of Washington, this update is one you don't want to miss. But before we dive into the details, do me a favor, hit the like button and subscribe to Daily Dollars for more Social Security and personal finance updates. Alright, let's get started. Now, before we break down the details of how this deduction works, let's take a moment to understand the bigger picture. During the 2024 presidential campaign, President Donald Trump repeatedly promised to eliminate taxes on Social Security benefits. His message was no tax on Social Security, no tax on tips, no tax on overtime, which resonated with millions of working-class Americans and seniors alike. That message raised real hope that retirees could finally stop worrying about losing a portion of their Social Security income to federal taxes. However, once the campaign ended and legislation began taking shape, it became clear that eliminating taxes on Social Security entirely would be extremely expensive and politically difficult. The budget reconciliation process currently being used in Congress restricts changes to Social Security itself, making a full repeal of Social Security taxation almost impossible under current rules. Instead, lawmakers have pivoted to something more targeted and more affordable, a tax deduction focused exclusively on seniors. Under the current Senate proposal, individuals aged 65 and older would be eligible to claim a $6,000 deduction on their federal income taxes as long as their modified adjusted gross income is $75,000 or less. For married couples filing jointly, that income limit increases to $150,000, and both spouses can claim the deduction, potentially reducing household taxable income by up to $12,000. That's on top of the standard deduction you may already be taking, which means this could lead to significant tax savings for qualifying seniors. And here's a key detail. You don't need to itemize your tax return to qualify for this benefit. That's an important point because many retirees choose not to itemize, especially if they don't own a home or have significant deductions. This senior bonus is designed to work alongside the standard deduction, making it more accessible and useful to a wider group of seniors. Now, this deduction isn't unlimited. Like many targeted tax benefits, it comes with a phase-out. For every dollar you earn above the income threshold, the deduction gradually shrinks at a rate of 6%. By comparison, the House of Representatives previously passed a version of this bill offering a smaller $4,000 deduction with a slower 4% phase-out rate. In essence, the Senate's plan offers a larger benefit but phases out more quickly for those with slightly higher incomes. Policy experts say this makes the deduction more generous for seniors who are comfortably under the income cap, but less helpful for those closer to the threshold. Still, for millions of middle-income retirees, this change could provide welcome relief in the face of rising prices on everything from groceries to prescription medications. Howard Gleckman, a senior fellow at the Urban Brookings Tax Policy Center, says the deduction is smartly designed to help the people who need it most, those in the middle zone of retirement income. These are seniors who make too much to qualify for low-income programs, but not enough to comfortably absorb higher living costs. This group is often overlooked in large-scale tax reform packages, and this proposal gives them some much-needed attention. Of course, we also have to acknowledge what this deduction isn't. It's not a credit, and it's not a refund. It's a deduction, meaning it reduces the amount of income you're taxed on, not the tax you owe directly. That distinction matters. While the benefit is still meaningful, it may not be as noticeable for low-income seniors who already owe little to no federal tax. That's why some advocates are calling for refundable tax credits or even monthly advance payments, options that would provide direct, tangible assistance to more seniors, especially those in financial distress. One proposal gaining traction is to offer seniors monthly benefits similar to the expanded child tax credit that families received during the pandemic. For example, a $250 or $300 monthly payment could offer real, consistent relief that would better align with how seniors actually manage their bills month to month. Some are also arguing that the eligibility age should be lowered from 65 to 62, in line with early Social Security eligibility, which would ensure the deduction helps more retirees who've already left the workforce. But for now, this $6,000 deduction is what's on the table. And there's one more caveat: it's temporary. If the bill passes, the deduction would apply to tax years 2025 through 2028, just 4 years. After that, it would expire unless Congress votes to extend it. This has drawn criticism from those who point out that many tax breaks for corporations and higher income earners are designed to be permanent, while those that help working Americans and seniors often come with expiration dates. This brings us to the current status of the bill. The House passed its version on May 22nd, including the original $4,000 deduction. The Senate is now reviewing the bill and negotiating changes, including the increased $6,000 figure and the faster phase-out rate. But here's the challenge. Once the Senate finishes its revisions, the bill must return to the House for final approval. And with the original version passing by just one vote, there's no guarantee the updated package will be accepted. On top of that, concerns about the national debt, which could increase by over $2.4 trillion over the next decade as a result of this tax bill, are already fueling debates about potential spending cuts to other programs like Medicaid, SNAP, and housing assistance. So, what does this all mean for you? If you're 65 or older and your income is under $75,000 as an individual, or under $150,000 as a couple, you could be eligible for up to $6,000 in added deductions on your taxes for each of the next 4 years. That's money that stays in your pocket and can be used to cover healthcare costs, housing, food, or simply to make life in retirement a little easier. But if you're under the age of 65, earn slightly more than the income cap, or already owe very little in federal taxes, this policy likely won't impact you much at all. And let's not forget, nothing is final yet. This bill still needs to clear several legislative hurdles, and negotiations could lead to changes in both the size of the deduction and who qualifies. What are your thoughts? Do you think this deduction is fair? Would you prefer monthly payments or permanent relief? Is this enough for today's seniors, or should Congress go further? Share your comments down below. And if you found today's video helpful, please do us a favor. Click the like button, subscribe to the channel, and turn on the notification bell so you never miss a key update about Social Security. Thanks you for watching. I will see you in the next video.